Global investors dial back US hedge fund exposure as Sell America narrative gains ground. Global investors are beginning to look beyond US hedge funds for the first time since 2023, signaling a subtle but notable shift in capital allocation as concerns over US trade policy and geopolitical uncertainty intensify, according to a new survey by Barclays. The reassessment follows sweeping Liberation Day tariffs announced by US President Donald Trump in April, which have reignited talk of a broader Sell America trade across global markets. Investors in the United States and Europe told Barclays they plan to increase exposure to US-based hedge funds by 5% less in 2026 than they did in 2025, while simultaneously stepping up allocation to managers in Asia and Europe. The findings are based on a survey of 342 institutional investors overseeing a combined $7.8 million in assets. Interest in Asia Pacific hedge funds are rebounded sharply, more than doubling from its 2024 lows, Barclays noted. European hedge funds are also enjoying renewed attention. US-based investors more than doubled their interest in European managers, while European investors reported being 8% more inclined to allocate capital locally compared with last year. Allocations to Asia-based hedge funds manager rose by roughly 10%. These regional diversification reflects a broader desire among investors to reduce concentration risk amid shifting global economic and political dynamics. Despite the relocation trend, hedge fund fees remained elevated by historical standards. Average management and performance fees peaked in 2025 for traditional hedge fund structures, typically charging just under the classic 220 model. Cost pass-through structures, however, have seen a decline in fees. Encouragingly for investors, their share for gross return has improved markedly, rising from about 47% in 2023 to 56% in 2026. Overall, hedge fund returns have increased by around 5% this year, according to the survey. Large multi-manager hedge funds continue to expand, with assets under management growing at an annual rate of approximately 17% since 2017 to reach about $435 billion last year. Yet they are no longer investors' top strategic choice. Instead, macro-focused hedge funds and systematic equity trading strategies attracted the strongest net inflows in 2025. Looking ahead, equity market neutral strategies are the most favored for 2026, followed closely by quant multi-strategy funds, which have dominated investors' preferences since 2020. Overall, the hedge fund industry grew by just over 20% between 2023 and 2025, marking its largest two-year expansion since the early 2010s. However, the latest data suggests that while growth continues, investors' enthusiasm for US-centric strategies is moderating in favor of a more geographically balanced approach.